in the United States since 2018. There have been 1,648 funds, venture funds started that were sub $300 million.
Welcome to the Smart Venture Podcast. We're here to bring you the latest and greatest from the Silicon Valley, where unicorns roam and innovation never sleeps. We've got top investors, superstar founders, and well-known tech executives lined up to share their secrets on building and investing in successful companies. Just a quick disclaimer, while we may sound like financial geniuses, but please don't mistake us for your friendly neighborhood financial advisors. So let's get started and dive into the wild world of tech entrepreneurship. Great news for all our Smart Venture Podcast listeners. Since January 8th, I've been hosting a new daily live show, Venture with Grace, on LinkedIn Live at 9 a.m. PT every weekday. Follow me, Grace Gone, on LinkedIn to catch up on past episodes and stay updated with future ones. You'll get insights from key industry players and have the chance to ask questions live. Don't forget to subscribe to the show on Apple Podcasts, Spotify, and our YouTube channel under the Live button. Join me on this journey and let's explore the world of innovation and investment together. Hi, welcome to Smart Venture Podcast today.
Thanks so much for having me.
So to start the show, I would love for the audience to get to know you a little bit more. I saw that you went to undergrad in Michigan, go like Michigan, because I went to school in the Midwest as well. So I would love for you to give us a little bit of insights on how you grew up and then what are some major life events that kind of shape you into who you are today.
Sure. So I was born and raised in Buffalo, New York. For those of you who can see me, you can see my Zoom background is a Buffalo Bills logo. So I use that because I like the Bills, but also it's a nice conversation starter because it's a little bit unusual because I live in the Bay Area now to be a Bills fan. So I went to college at the University of Michigan, and then I moved west and I went to grad school at Cal. And then I pretty much have been here ever since. I did a brief stint in New York with JP Morgan, but then came back and knew I wanted to be in California longer term. My parents both came to the United States for college or grad school. They met in Buffalo, New York. And so that's why I was born there. And then they lived there for, 40 some years before they eventually moved west with me. And they were not in the professional or corporate world. My father is actually a retired Presbyterian minister, and my mother was a small business owner. She had a few retail stores. And I spent about 10 years on Wall Street. Most of that time was Morgan Stanley San Francisco. I started in equity research covering software stocks, but not enterprise software. It was at the time called comm or communications software. So they were companies that were selling software into the Verizons of the world, if you can believe that was actually becoming its own space. They would sell billing software, call center, things like that. And then the bubble burst very quickly after I joined Wall Street. And my firm was owned by Chase and then bought JP Morgan. And then the bubble burst. So it was a really hard time. I survived quite a few rounds of layoffs. I followed my stocks to 3 different senior analysts and then thought, maybe I should think about doing something not so specific and more general. And I moved to the distribution side. So I had on a sales and trading desk where we distributed or sold a lot of IPOs and follow-on offerings. Again, most of that time, Morgan Stanley, San Francisco. And then while I was at Morgan Stanley, I was introduced and became educated on the institutional allocator side of the world. And so Morgan Stanley's buy side had, obviously had clients like large public pension plans and some endowments for some of their funds. And I started to learn more and more about that side of the business. And there were some of these groups that both allocate externally to managers, but also they have teams in-house who are picking stocks. And so we would cover them jointly with the buy side and the sell side of Morgan Stanley. And I thought, that seems really interesting. It's very long term. It's very strategic, thinking about asset allocation, but again, really taking a long view on investing that I was really interested in. And I thought might fit my style a little bit better. And so I moved to the investment management side of the world, and that was about 14 years ago. And I've been here ever since, more diversified initially, and then now focused on venture exclusively, and I love it.
I wonder, I feel like it sounds like I feel like you've been very great at like planning on your own career. I wonder who is on your personal board of advisors when it comes to making these career decisions.
It's a really good question. And, I will say when people sometimes ask me, like, how did you get into this? And, because I love my job so much right now. And I also say, it's been really circuitous. And if I had sort of any regrets, it would be like, oh, I wish I knew about this job sooner and had come into this role sooner. And yet at the same time, I'm sure, maybe you and a lot of your listeners have heard or read this book, it just, design thinking or designing your life.
Yeah.
And one of the things that's always stuck with me about that was the fallacy of having kids in college think about like, oh, what do you want to do? Or the interview question of like, what do you want to be in 10 years? Is, the long story short is, you make the best decisions you can with the information you have at the time. And again, being a child of immigrants who didn't grow up in a corporate world, I ended up on Wall Street because my mom's best friend's son worked at Goldman.
Mhm.
And I didn't really know what he did, but kind of hearing the Korean moms at church talk about it, I was like, I'm going to do that, whatever that is. And, so you just kind of, again, you make the best decisions you can with the information you have at the time. I
Mhm.
say that all the time. And I think, so in terms of, because I've taken this a little bit more circuitous route to where I am now, that personal board of advisors, I hope it's okay to say this, is actually, it has not been the same group of people the whole time,
Mm.
because I've just worked in like a lot of different areas. And, one thing I think about now, and I think about how do I serve that role for people who are, on our team or whom I meet just throughout my career, who maybe a little bit earlier on in their career, is there were just a lot of people who didn't really know me, who helped me along the way, who were open to taking a call or, a quick coffee, who really had no reason to. And I think about that a lot, and that I definitely wouldn't end up here if, probably 6 or 7 of these people along the way hadn't been so gracious. And so I'm really struggling with trying to find how to give that back, but also, be, quite frankly, everybody's busy, but also to be efficient about it, both for myself as well as with folks who are seeking counsel or advice or just a
Mhm.
sounding board, so to make sure that I'm the right person to give them the right advice for where they are in their journey, versus maybe they're better off talking to our mutual friend whom we just talked about before
Mhm.
we start recording or whatnot. So I'm not really avoiding the question. I'm not trying to avoid the question, but I
Mhm.
would say it's at every point of every job, I would say it was, generally speaking, either a supervisor or a mentor, but even in some cases, like it was a professor. I had an internship at Goldman when I was in grad school, and I got that through asking a professor if he knew anyone at Goldman. And he didn't know me that well. He
Mhm.
was a lecturer actually at Cal. And so, yeah, I'm really avoiding your question, not purposely, but
Yeah, I think it's a really valid answer because I think people grow a lot throughout their career and like you probably shouldn't just have like the, the same group of people you consult since like the beginning of the stage of your career to when your career evolved into like a more later stage to what it is today. And I think it's a total valid answer. And I like that you mentioned about like it's a few people, maybe you reach out to them that they are not necessarily having a lot of incentive to help you. However, they did help you. And
yeah,
I feel like there's a lot of serendipity in life and in career in general that like people are maybe like overlooking to a degree. And I think it's a totally valid answer. I wonder in terms of like building up skill set at like the current stage of your career, I wonder what would be like a soft skill or like a technical skill that you're constantly trying to get better at. It could be like sales or it could be like coding or things that you feel like are something that you're constantly trying to learn.
the beauty of this job and why I love it so much, because we make early stage fund commitments, and
Mm.
then we do direct investing at the growth stage, and then we have very large secondary practice. And
Mhm.
in all of those areas, we are very general. And so, we
Mhm.
do a little bit of healthcare, we do some consumer, we do some B2B, et cetera.
Mhm.
And so the intellectual stimulation is off the charts. So it's a really good question that you're asking, because it's something I'm probably sort of struggling with in the moment. There's so many areas you could lean into, right? And time is the only finite resource. And on the technical skill side, it's been a really long time since I've never coded. Well, I'm sorry, that's not true. I did in middle school. Just a little bit in a summer school program. But other than that, I've never coded. Frankly, I've thought about whether I should take a coding class, but I haven't. I've been more thinking recently about, it's been a long time since I built a model in Excel. And I'm even dating myself by calling it Excel because, when I build spreadsheets for my own personal use, I do them in Google Sheets, but I've never built, like a real bottoms up DCF like I did when I was a lot younger. I've actually been thinking, like, should I do that? Just for fun as an exercise. I really have been thinking that. And then, there's value in, I don't know if that would put me in flow state, but I've been kind of thinking about, just as a little tangent to your question, I think there's value just in terms of brain health and probably just from, wellness, et cetera, too. And finding something that can really put you in flow state. And I really like singing. And so I've been like, oh, should I find a voice coach? Because my girlfriend did this and she was saying she's doing this. She's setting out 45 minutes a week. And I was like, oh, I should do that. So I don't know if who knows when I'll actually get to executing on it. But I think there's value in just being, we're so constantly, just not distracted, but there's so many things you could spend time on. One of our GPs just published something where he said somehow he can track the amount of time that it would take someone to read his tweets, and now that the tweets can be long, they can be endless, but that just the rate of attention that our people are paying and the amount of, like, the average length of number of seconds that you spend reading something has gone down precipitously. And I think we all know that, sort of intuitively with the phones and everything. But I think kind of finding ways to ingest long form content and to really exercise your brain in a way that I think you have to be really deliberate about nowadays, I think is something that I've been thinking a lot about lately. And then on the soft side, which I'm really getting sort of a little vulnerable here, but I will tell you, you'll be like, oh yeah, she really needs that because of how this podcast has gone already, is I like details. I like to hear stories. And so I feel like the ability to bullet point, I'm really bad at making PowerPoints, because I think I'm like, oh, everything's important. The devil's in the details. God is in the details. And I think it's such a talent to be able to synthesize stuff and bullet point it like in the moment. And that's something I want to work on. And I think that's kind of I would characterize that as a soft skill. But there's that famous quote, like, I forget if it was Mark Twain. It was like, I didn't have time to write you a short letter, so I wrote you a long one. That is me. I really struggle with that. So anyway.
Oh wow. Like I really love like you're just like being vulnerable and sharing this. I don't think this is a bad thing because I do think a lot of detail matters. And I feel like being media personality or like quote unquote journalist, like I don't know, like people would call like podcaster a journalist or something. I feel like a lot of the devils is in the detail. It's for sure because I feel like when you're hearing people's story, a lot of times like it's very polished. However, when you ask them a separate question, you would think you would see actually how they answer them and how their brain works when they're out of their own like normal prepared story pattern. And I do think as a LP, it's actually an important fact to be like all over the place to actually seek like information that's like actually important. Basically, I don't necessarily think it's like a bad thing or anything, and I feel like you're humble enough to think this is like something you need to improve. I think that's just a great thought process to have. And I wonder, in terms of I'm sure you're like seeing thousands of pitches, especially in the current state. A lot of like GPs are trying to fundraise. I want to ask like a broader level of question is I've hear about when you were discussing in another podcast about the trend of the GP who are focusing on the generalist kind of things are going to be not as important. Maybe there will be the next generation of GP would be people who are specialized in, let's say, 2 or 3 subsectors. And I think that's great. But I guess, is there a lot of solo GP going to be merging into a bigger fund, or like what's going to happen in the next few years when people starting a fund? Maybe people are really hustling these days to try to get to, let's raise up fund one and then think about fund two. But I feel like to have longevity in the venture career, it really should be having a semi-thorough plan on what exactly going to be your unfair advantage going forward and how do you build it from maybe if call it year one now, from now to like year 10. What's your thought on where the venture industry is going? And then B, like what would be the core skill set to like the GP should have to dominate in the next 10 years?
Yeah, I think that the answer to both is related in that, so you listened to the other podcast, but generally, I think because of this explosion in the market that we've seen, and just for the benefit of folks who haven't heard that, just one quote I'll throw out that people are probably sick of hearing me say, but we ran this data, and in the United States since 2018, there have been 1,648 venture funds started that were sub $300 million. And that is almost quadruple the number it was about 10 years ago. And it goes along with just general growth in the asset class, because venture used to be kind of low double digits % of a institution's private markets allocation, and now it's about a quarter. And the amount of capital since '08 has again 10x, or not again, but has 10x from about 300 million to over 3 trillion. So that, you've seen a lot of the established branded managers get bigger, and then you've seen a lot of emerging managers start. I think because you've seen such a proliferation in the number of groups, and seed in particular is where the majority of them play and live, and you've now got a lot of our established friends coming down market as well. I think increasingly the need to, as you said, sort of differentiate it, or as you're alluding to, is really critical. And unfortunately, I think that, as an LP, I can kind of make fun of LPs, but I hope other LPs don't get offended. But I'm like, in the LP mind, we want to put you in a box and benchmark you against such and such. And that's what LPs do in the public markets, right? And so just having that context or frame of reference is how, I guess all investors are wired that way. It's just a little harder in venture. There's no benchmark specific to like fintech or whatnot. But that it's getting a little harder to, it's particularly for emerging managers to gauge the prospective success of a generalist fund. So saying I'm a generalist seed fund, if you're talking about a fund one or two, it's a little bit hard unless you've had some early companies that you've been associated with that, and this asset class takes so long to really figure out whether you were right or you just got a markup. But again, unless you're identified with some particular winners, I think it's a little challenging. And so then I think it takes time such that once you get to maybe if you're a generalist fund, once you get to a fund, maybe 3, that's typically when we see these funds start to turn over the LP base, or maybe not turn it over, but add to it from an institutional perspective. Very often they start with friends and family or family offices, and then in fund 3-ish start to add institutional LPs. And by that point, you could be a generalist, I think. And then you can then say, you've got some proof points in the portfolio. You can very credibly say, I have now done this enough that I know what good looks like. I know what a, whatever your fund name is, deal looks like. And so I think if you are sector, geo, or, just specific, sector geo specific, then it may be easier on a fund one, to be candid. If you're a generalist on a fund one, it may be a little bit harder, unless you can say, these are the 3 areas I'm focused on. And again, just trying to narrow it down for the LP brain, I think is critical. And then after a certain number of funds, you will be known for something. Right? You'll have had enough reps that you'll have some subject matter expertise in an area, even if you do call yourself a generalist fund.
Mm. If you're starting a fund today, or like, let's say you want to start a fund in like 2 years, what would be like your thinking framework to kind of just figure out what's your unfair advantage and then kind of like shape that into your strategy to build a concrete example through your fund one, or, pre-fund one, maybe like an angel portfolio or something?
Yeah, I think that presumably you're not just sort of like you fell off a truck and then you're going to start investing. So presumably there's some way that you've spent your, career up until now, whether, either.
Oh, I want to be mindful of like, oh, okay, so anything we said on this podcast is just for educational and entertainment
Oh,
purposes. So like none of this are financial advice. It's just basically for people's like educational and entertainment in general. I want to be compliant. So sorry.
great. Okay. Yeah, I think again, like presumably or obviously you're not probably starting a fund, as a high school student. So, you've spent time doing something and something about something. And you maybe angel invested. I think I don't want to keep saying the same thing, but again, just there will be proof points from your history of
Mm,
where you have a superpower or what area, either whether it's a knowledge area or again, sometimes it's your network or it's, there's one GP who had very little investing experience who, I mean, we'll see if it works out, but raised quite a bit of money, relatively successful. I mean, very successfully, that I heard like the superpower was the charm is an 11 out of 10, the charm factor of this person. I was like, and I'm not being entirely fair. He has worked at one of the, the most successful, still privately held companies ever.
mm,
But again, you're known for something. Like you worked at this firm, and then the network is just unbelievable.
mm,
I think that what you heard me talk about previously, just about the components of the venture role, right? The sourcing, the picking, the winning deals, and then the value add after the fact. I think one way to stand out to LPs as one thinks about raising a fund is, again, it's increasingly hard to differentiate on the sourcing and then the value add, because there are a lot of former operators or former or founders. But even if you're an experienced investor, your value add could be, we help you with fundraising, or we've seen this play out before, and the pattern matching and kind of, when companies go from 0 to 1, these are the issues you should think about. Like that advice is also quite valuable, but there are a lot of people who can offer that value add. I think that what we're finding more often is a lot of lessons being learned in funds 1 and 2 and even 3 by GPs, whether they are brand new to venture or they came from a bigger firm, around the actual specifics of running a fund.
mm,
So reserves.
mm,
Should I reserve? If so, how much?
mm,
How do I think about the companies that I'm going to reserve for? Is it just, and we've seen groups that, it's just whoever happened to come through the door first, and then they ran out of money. And then there's, a pay to play in a company that you actually have a lot of conviction in that just had a hiccup, and then you don't have any reserves to defend your position. Like this is a real story. I mean, and it's okay to not do or, have reserves. I think it's unpopular to do that. I think there's been a lot of like education of emerging managers, like, oh, you should have reserves. But, an LP friend of mine, Laura Thompson, she wrote, I thought, a very, very interesting piece about reserves and how there's a really strong sort of paper exercise argument to be made that maybe you shouldn't reserve. And there are some very famous, very successful storied brands that they don't, that's just what they're known for. Like, we're not going to be there at the B, and that's okay. The recycling, just the portfolio construction math, etc. I think we've seen a lot of groups that start with being syndicate players. that transition from, oh, okay, now I'm going to raise that fund 3, it's much bigger because now I want to lead deals. I don't think it's an obvious one. So convincing that you can lead, and I think people conflate, and it's accurate to do so, I think, but leading deals with having high ownership. Another one thing I actually have been hearing multiple times just in the last, like in this AGM season, is that the ownership to amount of time I'm spending with this company, where a lot of companies are needing a lot of handholding, that ratio is way off. And I need to think about that, from, again, a time utilization standpoint, where time is the only finite resource. And so I think thinking through things like that, I haven't seen or heard or met with a ton of emerging managers who have thought about and articulated really interesting or knowledgeable points of view on that. I think, I love this job. There's a lot of reason to love this job. I mean, in very few other industries, you get to think about like what could go right that would be so amazing and is going to change all of our lives. And it's so inspirational and fun. But there is a very real element of the business of getting a fund to, whatever your 5x or, whatever your target is for that return. And a lot of it comes down to math. Like you could be the best picker ever. And that's how a lot of emerging managers we see have raised funds, is because they say, oh, I invested as an angel in, name your favorite unicorn or 2 or 3, but it's meaningless to their returns because it was $10,000 or $5,000. And so that math problem of the fund construction can make or break you. And I don't feel like there's enough time spent on that.
I totally agree, which is why I feel like recently I've been structuring my show to feature a lot of New York VCs, because they are amazing I feel like they're amazing at math and fund construction. I think in Silicon Valley, people are really over indexing on like, oh, what about the product, the market, the go-to market, and like basically talk to your customer piece. But I feel like this is like I feel like New York VCs are fairly very savvy on the finance side of things. I feel like it just really reconstruct my brain on like portfolio construction and basically hearing about their thinking framework on how to think about the ownership piece. I wonder, one of the things I thought what you mentioned about right now, we all know where a lot of in terms of deal sourcing, people are typically sourcing at the usual suspects, either, I don't know, unicorn employee or
Right.
top tax school in the US kind of thing.
Yes.
So now it comes down to picking and winning. I think there's like 2 questions I have associated with both of the categories. One of them is in terms of picking. I think at a pre-seed or seed stage, since we're talking about emerging managers, I think it's very hard to pick. I think it's a numbers game, like what you said about like maybe the approach of not having any reserve is good, as like since picking is not very easy at a very early stage, and maybe you're better off if you just like invest equal amount of money into, let's say, call it like a 50 companies. I wonder if you're an LP, you're hearing this GP wants to go for the indexing approach, would you be excited, or would you be like, oh, you're just like everybody else, kind of that kind of things?
Yeah, our view generally is that we prefer more concentrated portfolios. So, if you have a seed fund that has a number of companies that's sort of got a 4 handle on, like 40 mumble or higher, it starts to get a little, in our view, hard to make that math work. That, again, I've talked about, ownership and fund size. And again, there's all these puzzle pieces there's all these parts of the math problem that have to work. The long story short is that we prefer a little bit more concentration in the portfolio. And, if I had to say sort of an ideal number, again, this may not necessarily be the house view. I think my partners and I would have, but we're kind of, we'll probably circle around the same median or average. But generally we like to see something, low 30s-ish. Like, again, if it's like 40 or 50, and then you start at 60, then it's not, no one company is going to be able to have that much impact unless it ends up being Google, fine. So, and then the other thing I will comment on is, you may hear these stories in venture land of like, oh, the deal that I missed, right? Like, oh, we were in the same building and I didn't invest in that startup and it ended up being, it's a $10 billion publicly traded company today. I think the one thing that I would say about that is it's not like investing in a public stock where the outcome is going to be the same irrespective of whether you invested or I invested. I think one of the interesting things about venture is that because of the governance, even though we're, obviously we don't invest for control, but because the investors have so much time that they spent and because of the value add piece, they can affect the outcome if they're a good VC. Meaning, just because, maybe if I had done the deal, it actually wouldn't have ended up being a good outcome because I'm not able to give as good advice or counsel, or I don't know as much about this or that, or I don't have the same network as you. And so I think also, again, that from that ownership to time ratio, particularly if you're a newer GP, we want to see your portfolio be a little bit more concentrated, because we want you to bring all of your superpowers to bear for the benefit of that company to try to affect an even bigger outcome than maybe that company would have enjoyed if it were someone else who had taken that position on the cap table. And so thinking about that with respect to how your time scales, right, and what value you can add and how much you can contribute and where, I think is important. I realize this could seem contradictory to what I said about that the value add is hard for LPs to gauge. And I don't mean that it's not important. It's critical because, again, you can have a big impact on the outcome of a company with the counsel that you provide to the company. I was earlier just saying the marketing decks are all the same. It's like I worked at this unicorn, I was trained as an associate at this firm, and I can give, advice or my network or whatever. So honing the pitch to LPs to really show, because it's all starting to kind of look the same, is important. But that I didn't mean, and I'm trying to make sure everyone's clear. Like the value add is very important. It's just as an LP looking at the marketing deck, it's hard to filter through.
I completely agree because I feel like I guess like the other question I have around this whole picking and winning is like about winning. So since you mentioned like, value add is very important. However, I feel like winning the deal sometimes have nothing to do with like directly what value you can add, because that's all about like a pitch, right? So you invest before you add value to the founder, or like maybe you have sent them like an employee before or something. I wonder, from an LP's perspective, since you're hearing like thousands of pitches every single day, in terms of winning, like, is there any really great story, like, an emerging manager, maybe without like a mega amount of resources and then competing with the tier one VC firm and then they win the deal kind of story?
We hear them from the managers themselves saying, oh, I've literally heard it 3 times today in 3 different meetings.
Yeah,
So I
yeah.
happened to do a few emerging manager calls just today. And like, oh, I won this deal from, again, a very large firm, and I won this deal. And it's great. I kind of sometimes have joked with my partners, I'm like, we have no way of verifying that is true in most of the cases, but I take it at face value. I generally think most people are honest. But in those cases, when they say they've won, it's really around, again, that being known for somebody important to the founder, whether because of a personal relationship or because you had helped them in the past. Somebody who's important to the founder has called in on your behalf, or many people. Some founders sometimes it comes down just to price. I think that does happen. But in other cases, I feel like I would venture to say in most of the stories that we hear, in most of the cases, it's really about a relationship, or again, that people in the mutual network who were important to the CEO or the founder vouched for them and said, I had a great experience with this person, or you're working on X and this person is extremely knowledgeable or talented or connected in X. I think I'm trying to think of, the reason why, I mean, I was going to say, like, sort of think about it from the converse perspective is when the bigger brands win seed deals or, against emerging managers, it seems like oftentimes they'll bear hug the founder with, all the partners show up at their house at, 7 a.m. with donuts and
What?
all of them. And, or, you hear stories like that. But I think it's a conventional wisdom is that it's easier for the branded managers to win the deals versus the unbranded. But I'm not 100% sure that that's still the case in, 95% of the time anymore. I think the seed stage funds are doing a very effective job of convincing the founders not to take money from a multi-stage firm at the seed. They're really selling against them, saying like, oh, it could be negative signal if they don't show up later, or you're not going to get any time or energy from them. They'll say they've got, 100 operating partners who are going to help you, but it's really a pull, again, from what I've heard in how they're selling against them by saying that's a pull. It's really incumbent upon you, the CEO founder, to chase down their head of marketing or whatever to help you.
Mm-hmm.
Even though they have this big army of staff, versus if you're a seed stage manager, you don't have an army, but you're hustling yourself and you're texting, you're WhatsApping, and it's very much like you're kind of helping build the company together. We're hearing that pitch to the founders is really resonating. And I think that there are now enough other founders out there who have been invested at the seed by bigger firms who then don't follow on. And then they have to spend actually a bunch of time explaining the negative signal to the downstream, to the A or the B. They're like, oh, why aren't they leading? Or why aren't they, like, that phenomenon is real. And so I think there are enough founders out there now who have experienced that I'm hearing they're telling the other founders like, hey, there are pros and cons to the deep pockets, versus you're going to have to find a new lead, for every round or whatever.
I wonder, since like I feel like, okay, so it sounds like for as in the LP arena, people are still very open to, let's say, like the storytelling and then I guess like the founder story of the fund kind of thing. But there is also, I feel like there's a rising of like different type of data analytics tool, even LPs could be using to examine if a GP is good. There's like, basically I feel like I've seen recently so many, even my audience is building a tool for LPs to examine if the GP were good. And I wonder, like, when as a LP, I guess, like, how much would you emphasize on like these people's storytelling skills, and how much would you emphasize on like, their actual, since like there's no, I guess, no actual data is backing that XYZ's portfolio is good when they are coming to you, since they're like maybe it's their like fund 3 or something, not like a lot of data going on. And I wonder what would actually be your mental checklist of this person if they could really make the fund return X amount of money, because the end of the day it's a financial product the GP is selling. So I wonder what's your like thought process on judging these different things, and maybe the data tools plays in this thing too.
So for folks who aren't spinning out of a bigger firm where there is no data, let's talk about that. Because, as an LP that's been doing it for, 24 years, we've got a lot of data because we've met a lot of funds in the past. And so we also know, if you're saying you did this deal, but, your former firm is saying they did, like we have a lot of data historically, so we can gut or accuracy check that. But if you're talking about someone who's sort of net new, maybe has done angel investing and then is now coming to the operating side, or sorry, to the investing side from the operating side, there are some heuristics that we use that won't necessarily be the monies in the bank from the DPI, but in terms of your ability to pick, presumably you've got, again, some angel portfolio or whatnot. And we do have a balanced view on that, because I do understand that, you are going to be shown a lot more things as an angel than will be in scope for the fund that you're raising. Probably it'll be stuff from friends, people, friends of friends. And we're very we're very understanding of the fact that like this portfolio, like there's probably some social pressure, right? The check sizes aren't big, And so there'll be more noise in there, generally speaking. But in terms of, kind of teasing out and showing like, here is the stuff from my angel track record that's relevant. If there, like I was talking about earlier, there should be a theme throughout that, presumably, that you can see, whether it was, even if it was as general as the founders all had this kind of, they were all, I don't know, they all had this kind of background, or, maybe there's some theme that has helped you narrow down what you say you're going to focus on in the fund. And, so again, there should be some signals in the track record, even if it's very new and you're on a fund 3, in terms of markups in the portfolio, or even, if for whatever reason the company's been very efficient, you could actually talk about the traction of the company itself, as opposed to that we got a valuation markup. Then the other thing I think is a little easier to gauge more near term is the winning. And there, I kind of laugh sometimes because, there are people who will pitch you who, you want to avoid just having a bunch of people who are very charming and good at telling the story, who raise the money or who raise funds or who are successful at raising funds. But at the same time, there is some reason why that is important, because if you alienate me as an LP, then, and I don't like you, or you did something that I thought was really off base just as a human being, then I come back to the winning piece of it. Like, why would you win deals with unless you're, again, exceptionally known for something, which I think takes time to build that. Once you are, or if you're successful and you're known for something, you can kind of be a jerk or, whatever, or, you don't have to be like the most popular or likable person, but, the LPs, like, we do talk about, like, if you turn me off because you acted this way, or you said something really weird, why wouldn't I assume that you're going to alienate founders that way also? Right? And so the winning deals, it's a little more squishy in terms of why people win. But, we have a very big team and, big network, because we've been doing venture for so long. So we make a ton of calls and we uncover a lot of stuff and can kind of figure out why someone won. And then if, obviously a very standard question when we do founder references is, would you ever work with them again? Have you sent them deals? And most of the time, a lot of people don't want to give negative references, but if you ask, kind of just pull on the threads. I mean, we've had situations where I think the GP thinks that the founder would work with them again, and the founder's like, don't tell him, but I will never work with him again because he did this one time in boardroom and I can't trust him. And so we're very pleasant externally, but and that's a personality thing too, right? Like if someone's tribal, or like they're, you cross them once and you don't know you crossed them, and then you're done in their minds, like that comes out.
Oh my God. Oh God. So I feel like, I wonder, in terms of like letting other people sending you as emerging GP. So, on one hand, you have to win deals from these bigger firms. On the other hand, you have to let other people share a deal with you. I guess it kind of come down to the deal flow. Would you be the person who find these deals first and then passing along to bigger firms so that they could, you could collaborate with them? Is that better? Or like, is that like, you have to be like a really good like add-on person to like a certain cap table, like the tier 1 partners want to have you because you have this XYZ specialties or something? Like, which one, as an LP, when you're like looking at the fund manager, would you say the people who are like bringing in deal flow to other people, that's like a better trade, or versus like the guy or girl who is like amazing at getting other people to add them on to these like cap tables?
Yeah, I think probably more the second.
Oh, okay.
And again, it just comes down to ownership and, generating a good return for your fund and your fund investors. If you are always a syndicate member, I think that your fund return probably, I suspect it wouldn't be as high returning as if you end up maybe, again, being a little more selfish, if you will, and not being so collaborative. I mean, I'm hearing that, we're hearing that a lot from our seed managers, that it used to be very collaborative and it's getting less so. And in the last few weeks, I've had 3 experienced GPs say to me, the days of getting 20% ownership are over. And, for a, single digit millions check. And I think that has real implications on, again, the portfolio construction model and math. And then if you are always a syndicate member and never a lead, I think you'll just make the math a lot harder. That's my
Okay. So basically the people who bring deals to other people, if they need it, or maybe they just like own the deal flow, like they just own like their own deal pipeline instead of other people sharing it with them, it's better, basically.
I say yes, because I'm assuming that when you are owning the deal pipeline, you're going to own more of it, of the company. Yeah.
Okay.
I'm assuming that goes hand in hand with writing up. If you're talking about the same size check for both, then sure, of course, it's better to be friendly and in a syndicate. But if you're talking about, I'm assuming you're talking about a pretty different check size, in which case I think it's just, again, I don't want to, I'm sorry to keep saying the same thing, but just it kind of comes back to the ownership.
I wonder, so okay, so I think like the other, like on the other podcast, something you said I feel like were really interesting, and I feel like it's like super true, is like essentially like if a fund manager who suggests like more fund manager to LPs, they may not want to win enough. I think it's like a really blunt truth. Maybe it's like hard for people to hear, but because I feel like in Silicon Valley, everyone is like having this abundant mindset, blah blah blah. So like basically people have to share everything with other people. But on the other hand, I think it is also like a reflection of essentially if you want to win enough, because it's after all, it's like an enterprise sales cycle for the emerging GPs to approach LPs. I wonder, from the enterprise sales analogy, what would be like a good way to have like basically your pipeline for pitching LPs? Because essentially also I feel like LP GP fit is like also another thing. Essentially, like, I guess like how, if you're an emerging manager today, coming from the LP's perspective, what would you say would be like 3 things that you do to actually build your funnel and then also like land the LP that you actually want to work with?
Yeah, I think I could boil it down to one thing, and then there's spokes in that. I think it's right or wrong. I think it's a public presence. If you're not somebody who's spinning out of a big brand, if, then, there are things that a lot of LPs will just, if you check the box, like, again, you were trained for, I don't know, 7 to 15 years, or you worked, for 7 to 15 years as a partner at a recognizable firm. That's different. If you're not in that category, I think I hate to say it this way, but it's kind of like what, you some of your podcasting friends have done. I think it's being visible in terms of getting in front of, tech journalists might hate me if I say this because they're going to get inundated by emerging managers, but, being publicly known for something, again, whether it's you're related to a specific company that's the hot company sector, or you're just an expert on, I don't know, early stage investing or some area, and then getting that public press so that when you're Googled, it shows up. Again, coming at you like, we're all human beings. And so cutting through the noise of these, thousands of emerging managers with LPs is really hard. And so for me, I feel like a lot of the groups that I've seen have more success with it are ones that have a pretty active Twitter presence, or they're posting on LinkedIn, and not just goofy stuff either, right? It has to be thoughtful and somewhat interesting, as you're doing, like having interesting folks on a podcast or speaking at conferences where you've shown again, you have some expertise in something, or you're respected for something. I really think that other than that, because I already said your existing LPs could introduce you to other LPs. But like I said, and your GP friends who are not competing in the same area as you, those intros also kind of make sense. But otherwise, I mean, people will do it for you, but as you heard me say, like, I just think it's odd when GPs introduce us to other GPs who are competing with them head on for deals and LP dollars. It makes no sense to me. Just think, it just tells me you're not that ambitious or aggressive.
I'm taking notes. I wonder, I think it's a really good way to like look at it too, because ultimately you have to be able to win as like it's essentially like the end benchmark is technically your performance. And I feel like you could be friendly with many people, but end of day, you're responsible for other people's money. So it's not supposed to be like, oh, I want to keep a friendly relationship with so and so, and like so I have to sacrifice my performance. I feel like that's a good, just like a really good reminder, essentially. And I wonder, okay, so I know we're about to hit the time, and I want to be mindful of your time. I want to end with like a little fire round for you. So, okay, what's your favorite book?
It's this is recency bias. There's a book by a guy called Richard Reeves called, I always get it wrong. It's either of boys and men or of men and boys. And it's about how I think the education system is really designed for a different type of behavior and attention span than the sort of the generally accepted, sort of generalizing wildly of boys. And it's actually causing a lot of downstream impact on society with, there are statistics around the percentage of girls and versus boys in higher education, or, in college and in graduate schools, et cetera. But also that this has led to a lot of young men feeling very disenfranchised, and that it may be why we have a lot of, deaths of despair, a lot of drug use, and a lot of really extreme social views on the part of, some young men. And I think it all starts with education and the education system. That's just really anachronistic. So I've been giving it away like I'm the author's agent. I must have
You're
bought
the
like
author's
20.
agent?
No, I'm not. I'm not.
Oh, okay.
But
I'm
I've been
like,
like, I'm
what?
like,
Okay.
I've
You're
given
not
it away
okay.
as gifts, or like, just to people
Oh
so many
yeah.
times that you would think that I worked for the publishing company or something, but
Oh my God. I will totally take a listen. You don't have to send me anything at this point, but okay. That's an interesting book, sounds like. Who made the biggest impact in your career?
In my career, well, I think because the move from Wall Street to where I worked in the past was not an obvious or natural one. I would say my boss it is a firm called Common Fund, and that's where I went right after Morgan Stanley. And again, it was a very not typical move, but he knew me from Morgan Stanley and took a chance on me. And so again, it's all a chain of events, but it would have been a lot more natural to it wasn't a natural move.
Who would you invite to your dinner party?
So I'm not gonna, you mean just one person or?
It's your party.
Oh, so I like to host dinner parties quite a bit, actually, professionally. And I bring different groups of people together to talk about, different topics, but usually related to investing. And I'll like I have an early stage person there and a few CIOs. And so I'm going to answer that way. I'm going to say, and I tried to have one recently with different asset classes. So there was someone from private credit, again, a few CIOs, head of private markets, and then a couple of direct investors at the growth stage and the seed stage. But I like to do that. So it's a work answer.
It's a work dinner.
It's a work dinner.
Where can we find you outside of work?
Hanging out with friends and at a happy hour. I don't know if that's socially acceptable to say. I'm not California sober the way that, everybody else is now.
What does your content diet look like? Like, what kind of content do you consume to educate yourself in the industry or just in general?
A lot of trade rags, like venture newsletters. We get a lot of pitch decks and we do a lot of calls with GPs. So a lot of my learning is actually live or Zoom learning, face to face, hearing stories. And then again, we get a lot of intel from PowerPoint presentations, and we get a lot of looks at, because we do the direct investing as well. We have a lot of access to information about companies, et cetera. My issue is I'm like inundated with information. And so it's sort of picking like, okay, I want to go deep on this today, or, for the next 2 hours or whatnot. That's the more challenge for me, just because of where we sit we have 280 manager relationships across our funds of funds, our separate accounts, and our advisory clients. And it's, it's between that and then the industry information, et cetera, and the deals that we're looking at, it's a lot to consume. So
For sure. Well, Sam, thank you so much for coming on the show today. I feel like you are very thoughtful with all the feedback that you've shared about the emerging manager ecosystem, and I feel like I've learned a lot.
Thanks so much. It was a fun conversation.
Thanks for tuning into Smart Venture Podcast. If you learned something from the episode or even just mildly tolerated me, please subscribe and leave a 5-star rating. I promise I will keep bringing you more successful, insightful interviews and insider tips about startups. Remember, sharing is caring. So tell your friends to listen too, or enemies, I won't judge. Until next time, keep venturing smartly.